What's up, traders? Welcome to this week's episode of the Weekly Watchlist, where I do a technical analysis and give you my thoughts on the tickers listed up above. We'll of course be checking in on the broad market. After that, we've got our core list of companies, and if you stick with me towards the end of today's video, I've got 7 additional trade ideas to share with you, so definitely stay tuned for that. As always, anything that we are associated with is linked down below in the description, and without further ado, let's jump right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. For structure this past week, we've certainly got more of a hammer-esque type candle with a decent sized lower wick. So we know that the sellers tried to push prices lower, but obviously the buyers responded in a pretty strong fashion with a decent close up towards the top of the weekly range here, which does strike me as a bullish takeaway. So buyers respond to lower prices and we're able to confirm them with a solid weekly close. From a structural perspective, I would say that the bulls are in control here. If we think about location as well, on the bar-to-bar count, we do have the higher low as well as the higher high, which does strike me as another bullish data point. But let's go a little bit further than that. Let's look at where the low of this week's candle went, right to the prior closing weekly lows that we had discussed in prior videos, right? This red close as well as this red close from the prior week as well. That's where we supported, that's where the buyers stepped up, and that's where we turned around from. So to me, another slightly more bullish data point. And look at where we've closed. It's a new high close on the weekly bar, right? The only other green candle here had that really lackluster and pretty impressive, I would say, upper wick from the sellers stepping up at these highs, but we were able to close up there in that upper wick, which we'll of course see on the daily time frame in just a moment. So overall, it does seem that the structure and location would support a slight shift towards the bull bias, but let's not forget about our weekly trend, right? Coming in from the all-time high, we've got a lower high here, a lower high here, a lower high here, and we were using this upper wick as the next lower high, but you know, it would seem reasonable that the market still could rally, put in another lower high from something like here to here, and that would keep us in a weekly downtrend as well. So it's not like we're completely out of the woods, but it would seem reasonable that the market, based on this structure and location right here, could move slightly higher and take out this upper wick. Again, that just wouldn't be enough to completely change the weekly trend that we've been watching for. Let's take a quick peek at our volume profile here and see what's taking place from this perspective. What I think is extremely interesting is we know that 340 was sort of our downside level, and we were rejecting continuously this upper high volume node here. Remember that we were stuck kind of in this low volume void, if you will. We had rejected this upper ledge a couple of times, but that's exactly where we closed out in the past week's worth of trade. So now going forward, what would be the next reasonable area to watch out for? Well, it's either going to be back down towards the lows here, obviously from a structural perspective, or if we continue in the upward direction, it's just all about the next high volume node overhead, at least from this perspective in this type of analysis, which brings us closer to that infamous SPY 390-ish zone that we had discussed for many weeks in this general section of the chart. So something to carry forward is that if we can turn this old high volume node right here that we were rejecting into support with a higher low above, maybe that starts to constitute a trend change on the weekly time frame chart, but obviously that would require multiple weekly bars to start panning out. So overall, some bullish structure and location starting to unfold here, but we are not out of the woods by any stretch of the imagination from a weekly trend perspective in terms of counting our lower highs. Let's get on down to the daily chart now and start doing an analysis of the levels that are in play, some of the psychology here as well. Let's pop on the 50 and 200 SMA. 200 is green, 50 is blue. We're zooming in here, and let's discuss weekly expected move first. Let me make this pretty for your eyes and viewing pleasure. There we go, center stage, nice and easy to see. So weekly expected move has obviously shifted in the bullish direction, right? If we are contained within this week's expected move, we are going to make a new higher high or just continuously produce a higher low, right? Something that does this or something that just gets trend continuation in the first place, both of which are bullish for starting a new daily uptrend, because what we would have would be a set of lows, higher lows, or just a higher high right out of the gates up and over this level right here. So expected move does strike me as bullish. Let's talk about why this chart is slightly tricky though, and obviously what we're dealing with is still this notorious balance area on the SPY daily time frame, right? Look at what happened on Tuesday. We gap up and out of the range. We fail back in for a close below. Pure price acceptance underneath on Wednesday. On Thursday, we reject with an upper wick right off the top, and only is it on Friday, excuse me, I'm sure you can tell I'm slightly under the weather, but anyways, I'm sure we get that slight close above 372, right? So pure rejection earlier on in the week, and only on Friday do we get the first daily bar close back above that 372. Before it was 371.50, but based on the intraday reversals, 372 is the more appropriate level now. So overall, at first, it did seem like the sellers were kind of in control, pushing prices lower, but only on Friday do we get the bullish engulfer, right? Because technically we test underneath the Thursday low, buyers respond, and that's where we move up towards the top here. Now, we'll make the argument that some of this was short squeeze and some of this was also new money buying on the Friday session. And when you combine those two, yeah, you should be looking for some follow through in the upward direction, especially once we sort of consider what we discussed on the weekly time frame, where yeah, the location and structure also seems to be more bullish than bearish from that perspective. So overall, going forward this week, some things that I would really pay close attention to are going to be your 372 level. Any price acceptance above that, bulls are kind of in control. I would look for the leg higher to get us closer to, namely, the main target I would focus on is 382. Reason being, that's where we know that the Fed hiked rates. It was a pop higher and then a complete collapse for this most recent down leg in the market. So 382 would be my primary upside target. We'll, of course, update you on Wednesday if we need to adjust and the market's just completely ripping to the upside. Any failures early on of 372 to hold, if we cannot hold above this zone in here and we fall back down underneath, then think about it like this. On the daily time frame chart, we've got possibly highs, lower highs, failing back down underneath constitutes yet again another look above and fail. So we've got look above and fail. We've got look above and fail. If this, falls back down again, it's another look above and fail. And maybe this time we actually rotate towards the bottom end of the range. Now, as we know, this is a pretty difficult section of the chart to be trading. Underneath 372, roughly all the way down to the single prints from 2 Fridays ago now at 363.50. We'll talk about that on the market profile, but you can see it's basically the equivalent of the Friday low as well. So regardless of whether or not you want to classify it as singles, Friday's low, whatever it is, anything in here is still technically building out, or trying to at least build out a set of higher lows from the daily time frame chart, which is going to make this incredibly tricky to trade in this general zone. So I think that we should limit ourselves to scalps and not being overly biased directionally in this zone here, 372 down to 363.50. If we are above this, lean on the bull case. Shorts that are piled in and still short in here are starting to get squeezed again, and we'll again show you the evidence for the short squeeze on Friday as well as new money buying, both of those things, right? And then anything that's underneath Friday's low, underneath those single prints, again, the number is 363.50. You could also use the bottom edge of the weekly expected move. That's where we open the door back up into some of these lower levels, namely 356.75, which was our focus from last week as a lower target, right? So that's what I'm focusing on here in the S&P 500 into this upcoming week. Again, anything that's underneath 372 in this range, I think it gets really tricky, especially noting that we've got earnings season upon us. All the heavy hitters are mostly reporting this week, so we'll see what comes of that. I'll show you the earnings calendar in just a moment. So that's your SPY analysis from a psychological and structural / location-based perspective. Let's quickly do a Fibonacci analysis. So from the lows of the CPI disaster up to the highs, notice that all of this consolidation has been happening above your 38.2, which would seem reasonable for bull flag consolidation, right? Are we building out a bull flag for a breakout to move higher? Certainly seems reasonable, again, given the fact that we're holding on to that 38.2. And then the last Fibonacci perspective I'll share with you is from the last rally high of September all the way down to the low. This is the first time that we actually got a daily bar close in this section, right? Back above the 38.2, which also is not ironically that 372 level that we were just discussing. So that also strikes me as a step in the bullish direction, but it's not a guarantee, right? This is just one singular data point. I really don't weigh into fibs too much. It's just another supporting piece of evidence, if you will. Let's take a quick peek through our sectors now and see what's going on from a sector perspective. Are we risk on, risk off, kind of any major structure here that we should be aware of? So XLB is up first. This is the materials sector, really lightweight sector. You'll notice it's just playing ping pong in this box. If we break out, it is going to be slight bullish pressure for the S&P 500, but because it's such a lightweight sector, I wouldn't look at it as a saving grace if everything else is red and the XLB is breaking out, right? It's just simply not going to save the day, but it could provide slight upward lift if the rest of the sectors are working out bullishly as well. Next up, we've got the XLY. What's going on in consumer discretionary? you'll notice that there's the possibility for a higher low here right off of our structure right in here. And we're also, we're not quite back inside of that range. So again, neutral kind of in this zone here. Higher lows above 145 start to feel much more bullish. And then anything that rejects here underneath 141.50. So if Friday's high cannot hold and we roll over, I would just look at that as a nice lower high on the daily time frame and possibly look for the rotation to the lows at 134.90. We'll call it for round number 6. So overall, this chart does have some proving to do. It doesn't look fantastic based on its location in relationship to this overall, original balance range that we've been tracking on things like the SPY itself. Next up, we've got the XLK. What's going on in the tech sector? This one actually is looking better. It's even better than the XLY. And the reason being is here's your original 4-day balance, right? That's kind of the zone right there. Look at where we closed on Friday, right? Even after a nasty inverted hammer on Thursday, we never violated the lows at 119.75. That was the flush point we discussed in the pre-market. And we closed on Friday back inside of the original balance here. So to me, that is certainly a step in the right direction. Again, big tech earnings are this week. So kind of don't hold your breath rather, that this remains bullish, but it is a step in the right direction from a location and structural perspective. What I would want to see going forward are, can we get higher lows above 122 now to confirm more of a bullish look, and that would, of course, keep us bullish in the S&P 500, but obviously failing back down underneath 119.75 opens the door right back up to the lows, and what you'll notice is that obviously from a downtrend perspective, this could clearly just be another set of lower highs. So still, some question marks are being left out there in the sectors. I think that flexibility will remain key, as I've been pointing out the past couple of weeks here, but it does appear that the market's trying to at least slow down the selling pressure, and we might be, it's still a question, but we might be on the verge of a turn for at least a temporary move higher in the S&P 500. Anyways, XLF Financials, this one looks much, much better from a structural perspective. There's your original balance area, right? We flirt lower. Look at where the higher low was produced above. 31 was the number we were discussing in last week's episodes. Held it to the T. Closed fairly strong on Friday. Unfortunately, not strong enough to get up and over that 32.50, but still steps extremely bullish here in the right direction. Maybe I shouldn't say extremely bullish, but definitely steps in the right direction. Bullish engulfer on Friday. The next step, obviously, is looking for that next higher high for the daily uptrend to sort of confirm. So we've got to get the move over 32.50. Higher low above that would then be ideal, so on and so forth. And this being the second heaviest weight that we watch, not technically by market cap, but in our lineup, I would watch financials very closely here to see if we can get that breach of 32.50 on the upswing, which would be bullish for your S&P 500. Very, very, very important sector to be watching here. XLF as we move into the upcoming week. XLI, as we know, industrial 7%, less of an important sector. Oops, we want this. Less of an important sector to be watching, but sort of just like materials, there's your balance range. If it breaks out of the top, slight bullish pressure for the market, but it's not going to save the day if everything else is bearish. So just carry it forward as a small bullish data point here. Energy still looks slightly concerning. Obviously, you've got your bull flag breakout look right here. And of course, energy is D for defensive. So we don't really want to see this pushing as aggressively to the upside. But I think what's starting to make sense in my head is that we'll neutralize this with the XLU, because utilities are also defensive and they're basically in the gutter, right? We'll look at that chart in just a moment. So if energy can sort of peel back just a little bit, or just at least do us a favor, energy, and not take out the all-time high, I think we'll be all right from a risk on, risk off perspective. But utilities are the one that's sort of keeping us neutral there. As long as utilities remain in the gutter, so to speak, we'll be all right. But energy, the chart at least itself, does look bullish. So don't be surprised if we do get some upward follow through, which wouldn't be great for the S&P 500. But I'm not entirely sure what to make of this move, at least at this juncture here in the marketplace. XLV perhaps is much more clear in terms of what we need to watch out for, right? And I've been talking about this dreaded zone for quite some time between 125 and 124. It's just horrendous, right? On Friday, we gapped underneath the level, but closed firmly above. I mean, is this going to be a higher low? Possibly, but we've seen this picture before where, suddenly it's back lower. So what I would love to see out of the XLV, sure, this is a higher low from here to here, but I would love to see, what I kind of want and need to see to really change my tone here, is the next higher low to definitely be above 125. Like, it can't come back down in here and then turn for the higher low. That's not what I want to see. Resolve this area, please, because we know the importance of this zone. If I just grab slightly more time here from the monthly balance perspective, right? Look at this zone here. that 125 is so critical from this perspective that, again, flirting with the higher low underneath it, I'm just not quite as confident in that type of move as opposed to definitively getting a higher low above where I can say, okay, things are starting to make a little bit more sense. So the chart does strike me as more bullish than bearish, obviously. We've got the possible higher low here. We've got a bullish engulfer. It's sort of like a seller's shut off, right? We took back 2 days worth of price action that the sellers put in 1 day's worth of bullish price action. So I would say the buyers have the upper hand, but please do us a favor, really confirm over 125, and then we'll go from there. But so far, so good. Steps in the right direction for the bulls. Next up, XLC. What's going on in the communications sector. So the possibility of sort of a really sloppy lower low double bottom. So from here to here's your lower low, but you're at the double bottom neckline around 50.72 with the possibility of kind of a higher low look here, at least some sort of bull flag being put in, 4 days of consolidation. So just watch 50.72 in your XLC. If it breaks out over it, that would strike me as a bullish look. For the S&P 500, do be mindful that obviously you're getting Google reporting earnings this upcoming week's worth of trade, which is a huge portion of your XLC. Next up, we've got the XLP. What's going on in consumer staples. Notice how this one's lagging slightly, or just maybe not lagging, but it's still in this box. It's not as aggressively towards the highs of the week, which does strike me as a decent look because please don't forget, this is also a D for defensive sector. We don't want it leading the market rally to the upside, which it certainly isn't. So this checks out. This checks out as looking fine here for the S&P 500. Utilities, as we were pointing out, are in the gutter. Really big move to the downside here. Remember that these two are D for defensive, so this is a good look to see this kind of finally stabilizing, but certainly off of the highs, which is what we were talking about, neutralizing that look in the XLE. So I'm not entirely convinced that that's an appropriate way to analyze the chart and the two and the relationship between the two. But nonetheless, utilities being lower here does strike me as more of a risk on type look as opposed to risk off. Risk off would look like utilities hanging out up here and breaking out for new highs, right? So this does strike me as okay for your S&P 500. Last but certainly not least, we've got the real estate sector. Just remember that this has a lot more to do with the wealth effect. We'll put a W here. So as people's home prices are seemingly lower, they feel, less wealthy, therefore they might be less inclined to spend more money outside of what they need for necessities, which is basically why the XLP is a defensive sector, right? So overall, this being on the lows is impacting people's wealth perception. If it starts to turn higher here a little bit, which I don't know it will because the TNX is obviously still being supported in the upward direction, rates that is, maybe that eases the pain in the XLY. We get more discretionary spending, but I'm not completely convinced based on the look of this chart. Obviously, this balance area is beneath the original balance area from here. We rejected it on the Tuesday session as well. So that's what I've got from a sector perspective. Let's take a quick peek at the ratio grid. So let me load that up quickly. Here's the ratio grid. If you don't know what this is, top right-hand corner shows you what it is, how to set it up, all that good stuff. But the top four are the risk-on sectors. And what I want to point out is that the XLK is starting to perk up just a little bit. Remember that this has really been the thorn in the side of the S&P 500, preventing it from having more of a risk-on look. Notice that the XLV healthcare looks great. The XLF financials looks great. XLY is coming in a little bit. But overall, obviously this is much more of a sideways look as opposed to a straight lower look. So if the XLK can perk up here a little bit, I think that the recipe or the ingredients are there rather for more of a bullish sort of small upside swing in the marketplace, right? The ingredients are definitely there if the XLK can perk up ever so slightly, especially when you pair that with what's going on in the bottom four. These are the risk off sectors, XLP going sideways. Again, this is a decent look for more of a risk on environment. Energy is still the thorn in the side, but again, pair that with utilities, which are diving off of a cliff. Do they neutralize each other? Again, I'm not entirely sure of that being a valid parallel to draw there. And then you've got real estate also in the gutter here. So it's really energy that needs to come down just a little bit. And XLK is starting to perk up. So again, I'll say it like this. The ingredients are there for the possibility of a swing higher in this marketplace if we can get two things to happen. XLK is starting to improve. We can see that here in the uptick. All we need is the energy sector to sort of back off just a little bit, and I think we'll be in the right market context. The next thing I want to show you is a ratio that we don't often look at, but I want to pull it up here. This is the XLY over the XLP. So this is consumer discretionary over consumer staples. As this is moving lower, obviously, that means that your marketplace is most likely moving lower. It's more of a risk-off environment, right? People are favoring consumer staple spending over discretionary spending. All I'm trying to point out here is that there's the possibility that this is starting to build out a higher low, right? Even on a more granular level, you've got the higher low double bottom here into this upcoming week. If this can make a move higher, that certainly would support more of a risk on market environment, noting that your XLY is getting more love, right? I know that's really faint in the background, but overall, this is definitely a relationship that you might want to keep an eye on: defensive spending versus discretionary spending. And if the discretionary spending can pick up a little bit, maybe again that supports a higher S&P 500, right? So let's get back on over to the platform here. And what we'll move into next is the TNX. TNX, 10-year interest rates. And this is pretty interesting because of what happened on Friday, obviously, right? So big gap up. However, it faded off all day on the quote-unquote rumors that the Fed is considering reevaluating their path going forward. Obviously, it's very likely. We've got almost a 99% certainty that we're getting the 75 basis point rate hike in November. And it's about a 50-50 shot right now for another 75 basis point rate hike in December. Again, you can keep tabs on this over on the Market Watch tool here. So here we go. Let's go to November 1st. Again, there's your 95% certainty that it's going to be a 75 basis point rate hike. And if we go to December, you'll notice that it's about a 50-50, right? We've got a couple of folks here still in the 25 basis point rate hike camp. I don't think that that's going to take place, but it's really a battle between 50 and then 75 basis point rate hike here. And again, the Fed did mention on Friday, some Fed presidents were mentioning, hey, we're going to reevaluate because we don't want to overdo it essentially with the rate hikes and have to backtrack in the marketplace. So pair that though, which is just, I don't know, what can we draw here? I'll draw like a megaphone, right? This is a really crummy drawing of a megaphone. Pair that talk with what the technical chart is telling us. Does this chart look bearish by any stretch of the imagination? Absolutely not, right? So I wouldn't really just read into the Fed saying, hey, we're about to pivot as a huge indication that the market and rates are all of a sudden going to plummet. They're going to come back down to like 3.0. I wouldn't look at it like that, right? The chart is obviously still bullish. We just barely faded off on the Friday session on the gap up, right? The other thing that takes place is now the Fed has all of a sudden set the precedent and put the verbiage out there that, hey, we're going to consider things. If all of a sudden the Fed comes back and says, you know what? Just kidding. You know, we're fine. We're on track. Let's continue to be aggressive with rate hikes. And this continues to take off to the upside. All of that hope gets sucked out of the market. And next thing you know, we find ourselves back down towards the lows, right? So just something to consider. Obviously, much more of a fundamental and it's not as objective of an analysis, right? We're not looking at data points and price levels. We're talking about feelings of the market, which is pretty subjective, and generally why I don't like to look into it too much. But those are my general thoughts on the TNX. Who knows? Maybe the sickness is getting to my head and I've just ranted there for no reason. But let me know in the comments if that was of any value to you. Something new that I want to look at here with you guys is the relationship between the dollar and the S&P 500. So this is the dollar up top, the DXY. It's dollar DXY on Thinkorswim. Then we've got the SPY itself, and we're looking at weekly charts here. What I want to point out is obviously there's the relationship that a higher dollar correlates to a slightly lower marketplace. It's not exact, but that's the general feeling, right? And what we've done here, if I actually drop these to daily charts, let's just go daily charts. Let's go your daily charts, please. Your daily charts. Good. If we look at the relationship here, right, as the dollar pushes higher, right, that's generally, if you look at this section right here, when the market moves lower. When the dollar pulls back, the market gets a little bit of reprieve, so on and so forth, right? As we pull back here, we get that rally, and then on this most recent leg higher, we've gotten this pushed lower in the S&P 500. So lower S&P, higher dollar. But look at what's taking place from a technical perspective on the dollar chart here from the daily point of view. You've got a high. Now you've got a set of lower highs and you're coming into a secondary trend line. So if this trend line breaks and we move to the primary support trend line, I'm not saying that the dollar is going to completely reverse and move back down to like 95. That's not what I'm arguing. But if we do get a secondary trend line break and move to the primary, it certainly would coincide beautifully with the structure on the SPY daily chart for a little bit of a squeeze out of this box, would it not? So this moves lower here to the trend line, a little bit of a squeeze, and then we'll see and have to reevaluate when and if we get to that 110 handle in the first place. So just something to consider, something I wanted to share with you guys today based on the lower high coming into the trend line, right? If this was a higher high coming into the trend line, it would not be nearly as bearish. A higher high pulling back into the trend line, that's usually a buy setup, not a breakdown setup. So anyways, dollar relationship, figured we'd touch on it in today's video. Let's go back on over to the side-by-sides. And we'll maximize this guy and take a quick look at some volatility products. So the VIX is up first. As we know, VIX is still hanging out in this higher box. Obviously, we are not nearly or close to moving into this lower box quite yet. All it's telling us, volatility is still here. There's still uncertainty on the horizon. So although we've looked at some bullish data points thus far, I'm not really, again, ready to say that we're out of the woods from a quote unquote bear market or downtrending market perspective, with the VIX still hanging out around 30, right? You just simply can't be. If this starts to move down towards 2050, that's a different story, and we'll reevaluate when and if it happens. But currently, this look and just getting more price acceptance up here, or VIX acceptance, not really price, but VIX acceptance up here is not really all that much of a sort of, hey, we're out of the woods signal quite yet. Let's take a look at the volatility of the volatility index. That's the VVIX. And all I would point out here is that we're sitting back down on that 85 historical low from this section of the chart here. Remember that this would just indicate that the flood effect that we've deemed it recently is on the table, right? So if everybody rushes into SPY puts, market makers have to sell those SPY puts, therefore they're net long the market. They don't want to be net long. They have to neutralize the delta. They go out and they sell ES. So they go from positive to neutral delta. They sell SPY shares, right? That's the flood effect. That's where we get this spiraling out of control. And that certainly could be a reasonable environment with the VVIX sitting on 85 and VIX itself still being elevated close to that 30 handle. Last volatility product we looked at are the VIX futures, so /VX. Going over to the trade tab, and I would just point out here, this is kind of all we've been pointing out with volatility futures, is that we're still in backwardation, right? A mild backwardation, inversion, whatever you want to call it here. And I'm sort of excited for the day where I can report to you that, hey, we're out of backwardation. You know, the risk has finally shifted to the proper skew in the bell curve, if you will, but we're not there yet. Current volatility far outweighs volatility of 59 VIX futures, right? So anyways, not out of the woods. Volatility is still telling us, hey, be very cautious in this market environment. Let's take a look at the market internals here. So bear with me as I set these up. Again, if you don't know what it is, top right-hand corner's got you a video tutorial on what it all means, how to set it up, how it'll help you make better intraday trading decisions. This is where I can really prove to you that on Friday, we definitely saw some short squeeze and new money buying. So step number one for new money buying is, did we see a breach of 300 million in the volume read? We absolutely did into the close on Friday. That does strike me as evidence of new money buyers stepping into the market. Where do we look at short squeeze, right? If we zoom in and look at what unfolded between Thursday and Friday. We talked about this in the pre-market live stream. There's your consolidation from Thursday afternoon where shorts are piling in. And then look at what happens. Breach it, squeeze those shorts out, pullback holds that level to the T. We talked about this in the pre-market live stream, right? Value area low was a critical component because it was aligned with that area. That's where the higher low gets put in, and then we run into the remainder of the day. So this more controlled buying is the new money buyer here. And this, out of the gates, is the short squeeze of anyone who went out short on Thursday evening or was short in the overnight session. So pair those two things together with a advanced decline read that also respected the zero line into the close of week and a bullish tick read into the close of week. And I would say that, yeah, there was some decent new money buying out there. It was nothing too impressive. Like, don't get me wrong, this doesn't mean that the market goes to 4,000. But in terms of who's participating in this marketplace right now, I think short-term shorts are out of here and some longer-term longs have stepped in to a mild degree. Again, it doesn't mean we go to 4,000, it just means short-term shorts are out, and there is some participation on the long side based on what we can see here from an internals perspective. Let's take a quick peek at the market profile, and this is just going to actually reiterate the same exact thing. Remember that single prints represent emotional buying activity in the upward direction, emotional selling activity in the downward direction. We know that this was up, though, based on the candle chart we just looked at. So short squeeze in the morning, again, where does your D period come right back down into on the pullback? If we draw it across, it was the afternoon consolidation lows from Thursday. Notice that the value area here did shift higher, and it's completely engulfing of the Thursday value area. So that is a step in the right direction, but the point of control was left slightly lower. If you include the last 15-minute session on the ES futures trading, it technically pops up to here, but I just look at the cash close, and anyways, the point of control was left slightly lower. So again, another one of those things that's more of a question mark. You could read into it from the bull perspective and say, okay, it just means that a majority of people bought the pullback there. The new money buyers bought the pullback, and that's where the average position was being held from. So all of those people are in profit, right, which is going to give them confidence and embolden the longs into the beginning of this upcoming week, anyone who bought the pullback on Friday morning, right? So that's all I've really got for you in the market profile from the ES. This, of course, has been repaired. This has been repaired. The structure up here is, it's not the greatest high. It's a little bit weak. It just doesn't really have meaningful excess. The M periods don't shoot out the top like what we'd like to see, but it's not the end of the world. It's not like we've got just a triple across the bottom here. So overall structure here would look more bullish than bearish based on the short squeeze and then new money buyers trending higher, right? It's not like we had a balance day. This was certainly a trend day. This is a balance day. This really thin and elongated definitely indicates more of a trend day. Again, new money buyers stepping into the market. So hopefully we've hit that point home enough. Let's get back on over to the platform and round out the broad market here. And then we'll hopefully send you on your way speed round through the companies today. So QQQ structure is going to be very similar. Psychology will be very similar. Here's the original balance. Let me actually adjust this, make it easier on the eyes. Thank you so much for sticking with me, by the way. I'm not sure if my sickness voice has deterred anyone just yet, if I'm just droning on, but I do appreciate everybody who's made it this far. Notice that we've got two inside bars of the Tuesday. We break out of that on Friday, and also we're getting some more price acceptance in the original balance zone, right? This is the original balance zone, sort of similar to what we discussed in the XLK. And what I would watch going forward, obviously, here is the gap overhead. So the QQQ might be more tradable just in the sense that we have better structure to watch out for overhead. So breaches of 277.18 close the gap up towards 279.50. I would watch that like a hawk because it's the top technically of the original 4-day balance there. Obviously the 3 days here and that high make this 282.85. Another upside target in the top edge of your weekly expected move is closer to the FOMC breakdown. When they raised rates, that number is 286. 286 is the top in here. And of course, we'll update you if we need to on the Wednesday midweek market update. To the bottom side, right? Let's think about the same structure. Obviously, we've got this in play as well. We didn't even really have to interact with the bottoms of singles from this Friday session, the red bar right there. Instead, the low was sort of contained to our prior structure here, rejection points, right? All of these lows as well supported, and that did hold up for a nice move higher, technically building out something like a daily bull flag with the possibility of a trend reversal here. So those are the levels that I'm going to be mindful of. Obviously, in the QQQ, you'll give it a little bit more leeway, or at least I would, and say that anything that kind of holds up above 267.50, that's going to be bullish and looking for higher towards the top of the range in there over the course of the coming week, trading through this gap as a very, it's not going to be easy to trade, but it's easy to identify the levels that you need to be paying attention to when and if we're trading through that range, right? So that's what I'd say about the Qs. Obviously, on your downside, if you're breaking down underneath 267.50, that opens up the door to move back lower here towards that 255.25. You preserve your weekly downtrend, which is much more apparent in the QQQ with your lower highs that are looking like this. So continuing along, IWM Russell 2000 and the small caps, and then we'll speed round through the core list of companies and the trade ideas. Obviously, this is just a brick. It's a brick of price action. We've gone nowhere really. So this trend is neutral on the weekly time frame. It's neutral on the daily time frame with equal lows and equal highs, and we're trading towards the upper third of the overall range. So your levels to watch out for, are just going to be 173. Break for a higher low above, bullish, watch for a breakout of the weekly, right? This would be a weekly double bottom over your neckline 177, rejections here and just trading around in this chop, be directionless, don't really fall in love with one side versus the other, and then breakdowns of 169.20. I'd probably look for the rotation back down to the bottom end of the range, noting that you've got this big look above and fail of the original balance range, right? We've been referring to the original balance ranges. Here it is in the IWM. We've spent most time above it, so it is more bullish than bearish, but failing back down underneath 169.20 certainly opens up the door for that 163.75 low end of the original balance. You know the deal. If you've made it this far, hit the thumbs up button, subscribe to the channel, all that good stuff, and let's get directly into Apple. I'm going to keep it pretty brief here. Not only is the voice tired, but the video is getting long. For bulls, you want to see the higher lows above 148.75. I would not really want to mess around in this zone here, given the chop and slop with the inverted hammer, the red bar, the bullish engulfer on Friday. So anything that's underneath that zone, in between 143.40, don't be overly directional, and then breakdowns of 143.40 open the door for lower into 138.25. Again, earnings are on Thursday after the close. Next up, we've got Netflix. You can see before I zoom in too much, we're inside the big boy gap from 3 earnings cycles ago here. Keep it very simple. We've got a 2-day balance from Wednesday and Thursday. Friday, we obviously break out to the upside, so I would lean on bullish outcomes. We've got nothing until 332.67. Pullbacks that hold 278.75 are optimally bullish. Any breakdowns under the 3-day lows obviously close the gap down underneath to 250, and that's underneath 265.25. Next up, we've got Tesla. Tesla earnings are in the rearview mirror, so all good from that perspective. We've got this daily balance area that's forming multiple tests underneath here, as well as here on Friday, with bullish outcomes closing back in the balance range. So I would look for bullish outcomes, but not, nothing crazy until we can get higher lows above and out of this range. That's going to be 220, 225. Obviously, bears are feeling much better underneath 205.25. This is putting in technically bear flag consolidation, so be skeptical on the bull side and probably wait for confirmation with the higher low above that 222.25. Can't really say much about this structure, kind of in the midpoint of the balance range right there. Next up, we've got Google with earnings after the close on Tuesday, so do be mindful of that. Anything I say here can be invalidated based on the earnings release. There's your overall daily balance. If it's going to turn into a weekly double bottom, it's got to breach this 103 level. Obviously, we gapped down on Friday, closed back in here. I mean, this chart is extremely ugly just from a structural perspective, right? You've got all of these rejections on Thursday as well. Gap down on Friday, no follow through from the sellers, close strong, back up at this level. Pretty sloppy. I would honestly just stay away from this until earnings has resolved. Don't want to get involved in that IV crush and theta crush with trading weekly options here. Next up is Meta. Obviously, earnings are on Wednesday. Maybe I shouldn't say obviously, but I've been tagging these things. Let me know if you find that helpful. In terms of the chart here, it's very similar to Google. Look at all of these rejections, right? We finally flush those lows, but it's a gap down and then we rally on Friday. So it's like, okay, who's in control here? Is it the sellers on the gap down or the buyers responding to these lower prices? I'm not overly convinced one way or another on Meta just yet. If we do rally early on in the week before earnings and roll over underneath here for a lower high, yeah, definitely look out for shorts on that possibility to retarget the open from Friday around 126.65. Bulls feeling much better with higher lows above 134, and bears, obviously, who want this thing to go to hell in a handbasket, want to see it underneath 122.50. Not convinced about that. That's probably not going to take place prior to earnings. I think that we hold our breath prior to, and maybe get small reactions that look like this, or small reactions that look like this before the earnings announcement. Next up is NVIDIA. This chart is also pretty sloppy and ugly. I don't love where it's sitting from a price action perspective. Sure, excuse me, we're in a daily downtrend that looks like this, but we're also kind of doing this, and look at where we are from the original multi-day balance here. Big failed upper wick on Thursday, followed up with a failure from the sellers underneath the inverted hammer low with a close strong on Friday. So again, more questions as opposed to answers inside of NVIDIA. Earnings are not really an issue here, but the primary focus for me would just be the gap close overhead, 126.85 up to 131. Playing around in here, don't get married to it. And then even for shorts, it's not really that clean underneath 121.25 given the lower wick from Friday. So really tough chart to trade in this kind of slop zone right here. Primary focus probably just the overhead gap if the market's bullish early on in the upcoming week. For shorts, things finally get back in gear underneath 114.50. Doesn't seem like a first priority early on in the week given Friday's close here. Next up, we've got Microsoft. This is reporting Tuesday after the close, so be mindful of that. Again, anything I say here, any analysis, any levels can go completely out the window. In terms of the structure, though, much more bullish, holding on to the flush point here from the multi-day lows, right? All of these lows never breached on Friday, strong close on Friday. I would watch for bullish follow through in something like Microsoft, but again, Tuesday earnings are going to throw a wrench in that. So the pattern does look good. Bull flag does look good. Bullish engulfer on Friday does look good. Early on, like Monday and even Tuesday during the day, you might watch for the gap to close overhead and possibly a rotation into those 3-day highs here. But I wouldn't bet the farm on it, right? Obviously, Tuesday earnings, anything can go either direction. Could be big up, could be big down. Just, wouldn't really want to be involved in that binary decision. So early on, pattern looks good, but be open to anything in Microsoft post earnings. We'll update you on Wednesday, of course. Amazon, last but not least, the mini beast Thursday after the close earnings. Again, if we're looking at a weekly double bottom, it's got to breach this neckline up here, 122.75. Doesn't really look to be in play early on in the week. Maybe, Tuesday higher low above Wednesday gets playable for something that looks like that, but now you're pushing right into those earnings. So a little bit more cautious here. Definitely feeling more bullish than bearish, obviously, on the inverted hammer engulfment. It didn't technically engulf. We didn't make the new lower low, but you get the gist that we gobbled up that upper wick, closed firm above and outside of the original balance. So I would carry forward a slight bullish stance from that perspective. So maybe early on in the week, it's just a rotation here, some balance, and then we'll reassess after the earnings announcement comes out on Thursday afternoon. Quick reminder to hit the thumbs up button, the subscribe button, the bell button, all those buttons YouTube tells us to tell you about, and let's get directly into the ideas. MU Micron is up first. Notice the balance area breaking out on the Friday session. Firm close over the top of balance and daily 50 SMA, the blue line, looking for day 2 of follow through to bring us closer to 58. So watching for bullish setups early on in the upcoming week. Earnings are not an issue here. Don't want to see prices underneath 55.15. Next up, Roblox. What's happening here? This is going to be an update. Remember, it was a short setup on Wednesday's video of last week, but notice how we remained in the balance. So now I would be open to either direction, either long or short, to close the gap underneath or move into the prior swing highs here. The balance just looks very clean. It's going to be very easy to identify the long over the top or the short underneath the bottom. So more of an update in Roblox. PayPal is up next as a short candidate. Notice that we're clearly in a downtrend. This exhibited extreme relative weakness on the Friday session compared to the broad market closing firmly up towards the inverted hammer highs, right? And we've got price acceptance back in this prior range. So short underneath the lows here at 82.75 to rotate back towards 80 even, the lows from back down in here. If it pops above 84.85, probably off the radar for a short candidate. Next up is UAL, United Airlines. What's taking place here? Obviously, you've got your 2-day balance on the earnings gap up, and now we're breaking out of that balance to the upside. Rejected off the 200 SMA, but if we can get more price acceptance above 40.35, look for the rotation here, 42 roughly, and then look left, thin structure from the breakdown. I would expect a backtest of 44.29 on the highest degree of the upswing from the breakout of this multi-day balance. The fact that we got the earnings gap up, it held, and now we're breaking out for continuation, to me does look like a bullish look here. Not interested if this rotates back down underneath 40.35, and more importantly, if it comes down underneath the lows at 38.65. Anything that comes back down into balance but does produce higher lows for a triangle, maybe it's back in play, but obviously violations of 38.65 are no good. Next up, we've got Disney, possible inverted head and shoulders, right? Something that looks like this, neckline breakout starting on Friday over 101.40, looking for the rotation into the 50 SMA and the breakdown point from here at 107 roughly. Thin structure from the breakdown, so I would imagine we could move through it relatively quickly as opposed to lethargically. Also notice that we gobbled up the inverted hammer wick from the Thursday session there on Friday. Not interested underneath 98.16. Next up, we've got ABBV. Remember that the XLV as a sector is trying to prove over that 125. So if this can continue over the breakout kind of in here and just get more price acceptance above 146.80, not only is there a bullish trade to be had in ABBV, earnings on Friday on this one, by the way, but that would also support a bullish XLV, which is bullish for your S&P 500. So just watching this as maybe more of a market indication as well. But ABBV does look good for a possible day 2 continuation, very similar to what we discussed in MU, as long as we're over 146.80. Next up, last but not least, we've got JWN Nordstrom's. What's going on here? Here is a multi-day balance. Obviously, we've got a multi-week, I would say, balance, and then a 4-day in the past week's worth of trade. No earnings to worry about on this guy, but if we can clear 2016, look left, big gap to close overhead all the way up to, let's pop the level on there, roughly up towards 23, right? So $3 runway of upside if we can get the breakout. Obviously, you don't want to see prices underneath this 1934. That's going to wrap up the video. I'm going to give the voice a break here. If you enjoyed the video, learned anything new, let me know in the comments section or by giving the video a thumbs up. That is always very appreciated. And with that being said, I wish you all a green trading week.